Right. Hey, thanks everybody. Looks like we got a pretty small but scrappy group. So, wow, what a year to be talking pre-harvest marketing plans. Right. We've got production problems in South America. Dan's going to talk more about that. Input costs are still way high. The drought areas in the U.S. seem like they're just creepily getting bigger and bigger. And by the way, Russia invaded Ukraine, two countries that, in 21, 22, were expected, at least as of February, by USDA to provide about 29% of world wheat exports. And so, a marketing plan that can steer your decisions and help take the emotion out of marketing would be a great thing right now. So let's kind of move forward and take a look at some of this stuff. What do we cover in these workshops? Well, okay, primarily there was always three things, right? Price targets. Which isn't new, and I think a lot of people apply that to their marketing plans. Pricing increments, and again, it's another thing I think we all do. The third thing, though, was those pricing dates that really force us and drive implementation. And one of the things that Dan and I did in these workshops, we always had our simplistic plan, right? 6 increments, 10,000 bushels, all that business, and they were pretty, typically lower because we wanted to fit the simulation. We didn't really say, well, what would we do if it was this year? And because we wanted people to walk away from this thing and create their own plan for 2022, not grab our plan for 2022. But let's take a look at that, right? What if we would apply some of these things to 2022? And let's say we grabbed 547.50, which was that January 1 price on the first trading day for December corn of January of this year. So let's call that our minimum. And like I say, I always like to do this, throw that thing in there and put them in order. And 27% of the time, right, we see at least a $2 increase. And so, like I say, I personally like that $2 bookend, 550 then and say 750. And where are we today? Well, it's been wild, right? We got as high as I saw once at 642. I think it's been even higher. It traded much lower. And the last time I looked, we was up in the 630s. So we are on track to maybe having the very first time, a trade or a close above 625, because so far that's been our highest, which would make this tied for the fifth strongest, change, right, from January to harvest high. So this thing is really moving up the charts as far as being a very bullish year. So I like this idea of at least $2. So if we were doing that, and forget about the bushels, right? That doesn't matter. But let's take this 6 increment year and throw in these price increments: 550 at the low end, 750, and keep the dates the same as we used in every one of our workshops. Okay, where are we? What would be our progress today? Well, okay, January 3rd, we were at 548, or technically about 547.5. That was what the close was. Well, we closed above 550 that very next day. So it's, and again, a comment I made a lot of times was, especially if you're going to have quite a few marketing increments, 6 in our example, let's go ahead and get one on the books. You never know what the year is going to be doing. And I'd argue that 550 is probably going to make people some money. Okay, so that was our first increment in the bag. Second increment got struck on February 11 when we closed above 590 at 595. So where are we? Okay, as of today, right, we've got 1/3 priced at an average CME December corn price of 575. Not a bad situation. And I don't think that, for most folks, you're going to make money on that 1/3 of your expected pre-harvest marketing. So that's not a bad thing. Where are we at today? Okay, well, again, we've traded through the 630 price target. Is it going to close there? I don't know. 2 o'clock, I guess we're going to find out. If it does, our plan would say, do that next increment. But I don't know, do you remember this slide? Right, we had this slide here. We always ran through it. Can I change my pre-harvest plan? And we always said yes. And we said, hey, if something changes and the market develops a strong uptrend, you may choose to do a couple of things. Well, I think, and Dan's going to hit a lot more on this, but I think it's fairly safe to say things have changed, right? And we've kind of developed a pretty strong uptrend. And so we said, you know what? You can do a couple of things. One, you could use a technical tool, right? A moving average, a trailing stop to follow the trend. and then the sale is going to be made when that sale signal is triggered. Not a bad idea. We always left that out there, then said, hey, what's yours, right? Talk to your broker. What would be the stop you'd want to use? Is it a trailing stop? Is it a technical tool? What is best? Another option you could do, or another marketing alternative you could do, would be to go ahead and make that sale. So like if we close above 6:30 today, go ahead, forward contract, sell futures, but maybe turn right around and buy a call option and turn that whole thing into a minimum price contract. Essentially saying, I've got the bushels locked in, but if the market keeps going, that call is going to make me some money. So that's also something to consider. I will show this though. On February 10, I did a presentation with the folks, some good folks in Gary County. And I used this slide and I said, hey, this might be the year, this might be a situation to throw in this weighted moving average, right? And I did that right there where that arrow is. And I said, just run that thing up, run it past that a little ways. Well, okay. If we were going to be waiting for a single close before that weighted moving average, arguably that wouldn't have worked very good in this instant, because that would have closed me out at 580. And if I was following my plan, I would have sold that second increment at 580 instead of taking the 595 that I should have done. So sometimes technical tools, and I think Dan often mentioned that in our workshops, especially as things heated up. He said, hey guys, technical tools, when we're seeing a lot of volatility, are going to be a whole lot less valuable because you can blow right through them. And that's an example of where that might have happened. I might throw out here a third thing you could consider. Okay. Yes, a technical tool allowing you to delay an incremental sale until that sale signal is triggered. So that's a good idea. But again, as Dan mentioned earlier, when volatility is great, technicals may send a false signal. Make the sale and re-own. Again, turn that forward contract or selling futures, turn that into a minimum price contract by buying a call option. A third thing I might toss out there is pull your price targets forward. For example, skip this price target, pull all those remaining targets forward, and add another higher target to the end, leaving all your decision dates in place. Because let's think about this. Here's our plan. We've already priced one increment at 556. We've already priced in second increment, our April 15, at 595. And here we are, March 4th, 2 months prior to our next decision date, and we're on our way to closing through that 630. Something you might think about doing is saying, let's skip 630. Let's pull the 670 from June 15 up to May 15, the 710 up to June 15, the 750 up to July 15, and add a new one in. And so essentially now I'm back to saying, okay, before I price my third increment, I'm shooting for 670, or I wait till May 15. Another thing in a very explosive market to consider. But again, you want to do that and make that decision. So either take that 630, be happy with being 50% priced, or say, hey, let's slow this whole thing down. Wait till we get the March prospective plantings. Let's wait till we get a little bit more information before I start selling major portions of my production. With that, I tell you what, I thank everybody for the time. And before I get into any more trouble, I'm going to turn this over to Dan and Rich. Thank you all so much. I'll still be on, but I'm going to turn this over to Dan.
All right. So Rich, go ahead and put my presentation up.
Yes. Yeah, you should be able to do that.
Mark, what you were just talking about, let's see here. Okay, are you seeing this screen?
Yes, you're good to go.
I've been in enough of these that this is always a moment of victory that the thing actually loaded, that you can go forth and not. But Mark, what you were just talking about is probably what, if we were talking about a wheat marketing plan, maybe what you do. You've had enough explosive run up in that probably would be time to reconsider what your price goals are. Now we're hindered some by the dryness that we have, probably in terms of people's boldness in pre-harvest pricing. But again, particularly with what's happened in the wheat market, coming out of the factors that that have been driving them of late. Again, Russia, Ukraine, U.S. drought prospects, crop acreage, all those really are supporting movement in the wheat. Grain market analysis and outlook, what we'll talk about here, wheat, corn, sorghum, and soybeans in our outlook today. There have been things afoot here of late in the grain markets, and we pay attention mainly, but in these workshops, we were paying attention to, yes, to the lead contracts to see where we're at, but also for corn, the Dees 22 corn. By the way, Rich, can you see my cursor when I use that?
Yes.
Okay, that helps a bunch. Okay, we were paying attention to new crop bids, 612. This was yesterday. Last I looked, Mark, it was still dancing around 630 just as for D's today, just down a penny or two from that. We'll see.
And Dan, I'm not sure what happened, but I'm not seeing it now.
A cursor?
Yeah.
Okay. Well, that's all right. There we go. Do you see it now? If not, that's okay. We'll go.
No, I'm not.
So anyway, the D's corn, D's 22, you can see on the to the left, 612 on yesterday's. Well, that would have been Thursday's closes. November at 1454. It's been really interesting how that ratio has been really hanging around 2.4, 2.43, something like that, very consistently, almost to the degree that the consistency of that makes you think that traders are well aware of that new crop planting ratio and affects them accordingly. And you can kind of see that in the March contracts for both soybeans and corn, one up 12, one up 10, but the new crop bids are almost the same. And note over there on the right hand side with wheat, hard red winter wheat, 1140 for March. Again, the March contracts are in their delivery period, so we're really paying attention now to the May contracts for our current cash prices. Anyway. 75-cent expanded trading limit, hit that yesterday for the May and the July and the September contracts, Dees as well, and then some decline seen later on. There's a number of you out in the country have and there's been a lot of discussion about how new crop bids for wheat in particular have been rolled from the July contract, basis July, to the September contract, and that always sort of made sense, I think, in these northern parts where a lot of times the harvest didn't happen until good parts of July, but this strong carry market is affecting how elevators are pricing new crop bids. So new crop bid off of 1070 is it's 63 cents lower than a new crop bid off of July. So there's a sort of financial protection going on. Mark, have you heard of any discussions of that occurring on your end?
No, I have not. I haven't noticed that. No.
So when we go on to DTN, which we may later, it's still showing new crop bids basis the July contract, but again, the quote talk in the country, what we hear from the Kansas wheat people, from what their customers have been saying, and as well as discussions elsewhere, is that when they actually talk with local elevators, that this extreme carry is especially in the wheat market is having an effect on which contract they're going off of. So and apparently we've switched from July to September, and that makes a big difference still. And also with the high volatility, we've heard of widening basis bids out into the country. Now, these bids, these cash prices, and these bids are from yesterday's markets, highest bids available in each of these areas. A lot of times they're representing the terminal elevators in, say, a Salina, Topeka, et cetera. That said, you watch the terminal elevators, you'll see some country elevators with better bids. So hot markets everywhere, I guess. So you look at corn cash bids on the low end, 743 in Topeka, interesting. High end 793 in Garden City. Strong basis in Garden, again, demand center for corn usage in the state of Kansas, in our part of the world, Western Corn Belt. So strong basis bids, generally pretty good everywhere except a little bit weaker in Topeka, although weaker in 743 is quite the deal. But then, Mark, in our winning the game scenarios, we spent a lot of time in a lot of these places looking at about a 30-cent basis. It seemed that historically is where we were. Interesting to see, even at those high bids, and the strong prices that you have. You see Colby Salina at 20 under, Topeka at 30 under, Columbus at 25 under. Again, Garden City exhibiting real strength in basis, 15 over, Hutchinson about 10 under. So when we look at cost of production, even with our updated numbers, we're still showing that we're making money on there as long as we get the bushels to spread the fixed costs out over. So, well, spread the sunk costs out over the money that's spent. So we need the bushels to keep the costs down. But I think on these, in most cases, we're still showing $1 more per bushel of profit. So interesting. Grain sorghum bids, cash bids for sorghum, depending on where you're at. Yesterday, again, sorghum relative to corn, a little bit stronger in Colby, 30 cents stronger in Salina, 40 cents stronger in Topeka. Garden City, 40 cents weaker. Again, Garden City's focused on local use, and these other markets more focused on the exports, I think. Hutchinson, a little stronger. Columbus, a little bit weaker. So, and even the new crop bids, it really varies in all these locations except for Garden City. You've got Garden City and Hutchinson, I guess. Well, in the first three locations anyway, you've got stronger new crop bids for grain sorghum than for corn. We'll talk about sorghum here in a little bit more on their supply demand issues. Soybean bids. These are astoundingly good prices, but the basis in a number of these locations has started to widen out some. And it really varies. It's widened out in the western part of the state. 85 under, 95 under in Garden City and Colby, about 40, 45, 30 in Salina, Hutchinson, Columbus. Again, Topeka, strong export bid there at 25 under. New crop bids, a lot of variation. Again, out in the west, about $1 under for new crop bids, 55 or so, 55, 60 in a lot of other parts of the state. And then wheat. Now, I've still got wheat basis there for new crop off of July. And even off of July, gracious sakes, it almost makes you wonder if I need to go back in the Topeka area and double check my numbers, make sure I've got the right number. But you've got, I probably do need to double check that. Anyway, the point is that with all the strength that's happening in the cash markets, we're seeing wheat prices. Those aren't soybean prices; they're wheat prices at 11.15, 11.30 thereabouts, 11.05. New crop bids holding up pretty decently. Some weakness in different areas. I did want to put this up also to show you the what's happening in the ethanol world. As part of what's going on in the energy markets, there's an impact on which states are showing the strongest bids for ethanol. It used to be with hands down that Kansas had the strongest ethanol plant bids for corn on the top end of any place with, clearing again, other states, 20, 30 cents. Well, you go to Illinois now, they have a stronger price on the top end than Kansas does. Again, we're at 7.55. Nebraska's got a higher top end bid. Some other states, mainly those two being pretty competitive. So interesting. I could see especially Illinois with the demand pull there, with higher fuel prices that we could see that as RBOB gasoline jumps up, we that demand pull coming through those plants could be affecting that. And you can see some of the trends now on the ethanol side. So why are we concerned about this? Well, if ethanol demand holds up and in its very inelastic manner, that just helps the corn price to stay strong all the way through. It helps us achieve those $2 plus goals that you run up goals that Mark's talking about in that marketing plan. So DDG prices going decently. Ethanol prices had turned down, now starting to turn up some. And corn prices, again, you got 22 in the kind of green, blue, and the red, 21, and then the 5-year average. Of course, we're way above the 5-year average right now. I just wanted to do a quick scan of the broader economic factors that are affecting the market. And again, now we've talked about these, and I hope we were consistent all the way through the meetings, that saying that part of our risk this year in the grain markets are both our risk and our opportunity has more to do with macroeconomic issues, geopolitical issues, and boy, we're right, but I wish we weren't. For the Dow Jones Industrial Average starting to get a little bit worried. You can see it's still at high levels, but starting to trend down now. By the way, we're you can see on these charts that we have the short-term, 3-day, these happen to be weekly charts, 3-period, 9-period, and 15 charts. When we get to corn and soybeans and wheat, we'll look pretty close at those and see what the trends are right at this moment in those different commodities. But you can see a kind of a downturn in the Dow Jones Industrial Average, that RSI, as we talked about that in a number of these meetings, it's below 50 at 41 something, and the rate of change week-to-week basis down a little bit over 6%. So you have the Dow Jones on the one hand showing weakness, the S&P 100 index also showing weakness. If anything, more clear to see that the short-term moving average broke through the intermediate and the little bit longer term, and again showing weakness. There's the inflation index that's not showing weakness, unfortunately. That's at the certainly can see that's here towards the end in an uptrend. In the last several weeks, up to taking out previous highs that we'd seen, and again RSI now at 71. That's you're getting to full blown bullishness. If you want to call prospects of higher inflation bullish, that for this anyway, and the change on a weekly basis in this index. Giving an indicator of what inflation is doing is up 26%. So interesting to put numbers to some of the things that we see out in the country, and what we see in our communities is gas prices jump 30-40 cents and things like that. The US dollar also jumping up, and normally we'd say, well, that's a great hindrance to US exports, but I think that in this year, countries are so desperate to get hold of grain, particularly wheat, that I think that it's probably, although it's a factor, it's not as much of a factor when people are desperate for food supplies. And of course, this is what we're seeing in terms of oil prices jumping way higher. Of course, Russia's major oil supplier for the U.S., for other parts of the world. As you can see, certainly a major uptrend. We're at the RSI is not at 50, it's not at 70, it's at 78. So it's really jumping a 50% rate of change week over week on oil prices. What a deal. Gasoline prices almost, well, if anything, gasoline prices showing even more strength. Again, RSI at 82, sharp uptrend, 53% run up. So I think these are sobering numbers when you think about the economic impact of them. Weekly retail and diesel prices. Interesting that as high as we're seeing prices now, really with the blue lines diesel, the brown line, gasoline, we're just getting back to where we were in the past when we had a long string of months and years where we were hanging around somewhere 325 to just under $4. So where will we go? That's the issue in this. We weren't dealing with wars and geopolitical issues before. So where will this all go? If you look back at about 2007, we did break over $4, and it'd be interesting to see if we keep inflating on this, where will that take us, and much less the impact on our pocketbooks. Where does that take us? Where does that take ethanol then? Where does it take grain, which we try to keep feeding ethanol plants? Natural gas, and that hasn't been running up quite so much, and maybe that's a positive harbinger a little bit for fertilizer prices, again, particularly nitrogen prices. So natural gas sort of more sideways than petroleum and just regular gasoline. And then there's this last index. It's called the Commodity Research Board, or CRB index. It has to do with bunching energy and agricultural commodities together. It's primarily my understanding of what's in there. And you can see that agricultural commodities, really all these commodities, energy and ag, has an RSI of about 85. I think that's the top number of what we've seen on anything here. So massive commodity inflation, commodity price inflation, and week over week change of 28%. So we're not waiting for inflation, we're living inflation. Kind of shift away from that macro info. So we're concerned about moisture. Latest U.S. Drought Monitor map that I could get hold of was on March 1st. And you can see anything that's not colored, that has any coloration to it, that again, from yellow to orange to dark orange to red to black, basically shows drought. And these drought areas, on looking at the left-hand chart, have really expanded. Encompasses all of Kansas, all of Nebraska, almost literally, except the very northwest corner of Iowa is involved in that. Good chunk of Missouri, heading up into the Dakotas. Interesting how there's kind of an area in the Dakotas that aren't as dry in the eastern parts of them, but heading to the west, pretty dry. Again, parts of Illinois, et cetera, all catching that. They've had some rain in the eastern Corn Belt to the degree that they're wondering about, even some rumors of wondering about delayed planting with all the rain that they've had. And then that encompasses, again, that kind of that southeast part of Illinois, all of Indiana, all of Ohio, et cetera. So you have kind of a back and forth between the areas that are really, really getting dry and some areas that have caught some rain. And last I'd read, I think La Nina is lingering, could affect us going on into this year, and that has all its own peculiar effects. Some other charts, you can see it from a short-term point of view. Wow, that northern Kansas, eastern half, 2/3 Nebraska, almost all of Iowa showing a lot of dry conditions. And then there's that rain streak that came heading off the eastern Corn Belt. So that's in the short-term view. The longer-term view, shows more dryness, more lingering long-term impact in the western part of the U.S. than the short-term. And just another 30-day and 90-day accumulated rainfall, you can really see these streaks of dryness coming through these areas. And just to take a quick look at the world situation, Mark and I, before this started, we're talking about latest reports out of Argentina indicating that in country, they're thinking they have about 48 million metric tons of corn coming. And the USDA just in their February report had said, well, they're forecasting 54. So that's not a trifling difference. That's a major difference. So you've got those issues, cutbacks that have occurred in soybean production in southern Brazil. Paraguay is impacted by that. You can see up into Canada, dry impacts in spring wheat and barley, canola areas. When you look over into Europe, you don't see a lot of dryness right now affecting crops in the Black Sea area. We have all the Russia-Ukraine issue that's coming in, affecting, probably bringing about the big question in the world. It's not so much weather in that area, but their ability to plant a corn crop this year, or their ability to even harvest a wheat crop. And if so, can they move it to port? Are they going to be able to bring that into the world market or not? Those are just major questions this year. Let's talk about wheat. Wheat markets. And again, all these issues are happening geopolitically, affecting world trade, etc. It's almost quiet with regard to the ability left to focus on how dry and at risk the winter wheat crop is this year in the United States. So 73% of, again, as of March 1, 73% of winter wheat production is in an area experiencing drought. And so, Mark, as you and I talked about the need for rain and the opportunity with these prices this year to grow crops, we have to navigate and advocate for wheat, and especially the dry conditions that we see. Interesting for spring wheat, that one area that they've got some relief in the eastern part of North and South Dakota. We'll see. They need a good crop up there. The issue is, what are they going to plant? Where are they going to plant wheat, given the prices of all these other crops? So you can see the May Kansas hard red winter wheat chart, and just shooting tremendously higher in the last several weeks. Again, following, if we didn't have Russia, Ukraine happening, we'd still have strong markets because of the drought. But with that happening, those two things together, just amazing run up. We were trading just below $9. Now we're at $11.50. So can you say that whole, let's see, so 9, 10, that's $2.50 higher. $2.50 higher. I'd have to get my calculator out, figure what percent that is from $9, but that's, we've had quite the jump. So now, and again, I'd looked before this started, and the markets were up the limit again. So this right now, as we speak, if those same run-ups endure, that's probably 12.25 right now. We'd have to look. I don't have that right in front of me. And here we wanted to bring some of these charts in. We talked a lot about technicals and whether you price right now. So Mark, if we had a wheat plan right now, and we're wondering about, and we had a price goal that we'd met, and we wondered about pricing, this is probably a prime case for where, gosh, the trend is up. And do you price now once you've hit a goal, or let a technical signal change you? Of course, look at the volatility too. It's kind of the other side of it. But the you can see the RSI strong, trend going higher. Any thoughts on that, Mark?
I tell you, the only thing I'd say is, you're absolutely right. Yeah, I mean, that obviously that's a massive change. In probably the short run, that's the one market. I mean, we're seeing price strengthen everywhere, but that's the biggest one that's been impacted here just lately. And so, yeah, everything has just been turned on its head from a wheat standpoint. I mean, they're not going to be able to get it shipped out, and then we don't know if this fall they'll be able to get it hardly planted. And so there's a ton of things. And so definitely, I think from a planning standpoint, yeah, a guy needs to sit back and say, yeah, let's back some of these things off a little bit, and maybe this might be a good place to do the old pull your targets forward and hold off right now from making decisions right now. And also, probably everybody needs to make a pretty good a review of what are my yield expectations. And so then how does that relate to how much I want to price pre-harvest? If my harvest expectations are now like maybe 2/3 of what I thought a couple months ago because it's just so doggone dry, we probably need to be making those same kind of changes in our pre-harvest marketing bushels, which bleeds into our plan.
And you would sure wonder, although we've been focusing on pre-harvest, I don't know that we would shift gears, but once people actually get a crop this year, then really the plan probably switches over to the same type of thinking on a harvest to post-harvest goal. So I'm not unilaterally making a policy change on how we approach this, but once people do get the crop harvested this year for wheat, then they'll be wondering how to market in a disciplined manner in the post-harvest timeframe, given the risks and uncertainty going forward. So interesting. I also put in the daily prices. Now the weeklies, I like to watch the weeklies for long-term perspective. On the daily side, if you were trading, you'd be making daily decisions, and that's what we were doing in those workshops. And strong uptrend. Just again, you've got the 3-day moving average of 1047 and the closing price at 1116. So just racing higher. And on today's market, I'm not sure if the fears of a nuclear reactor issue that came out, that's all part of this as well. So quite the deal. A 39, almost 40% daily change. Just amazing. So wheat exports, just wanted to show a few numbers here. We've been up and down on. Last week we had a strong export week, 21, 22 million bushels. This week came back down to 13. You can see on the edge of that first line there. I've long been of the opinion that our exports haven't really been of the pace to really probably merit the prices that we're at. We're not having crazy exports, but it's the fear of what might happen of tight world supplies and the world having really, limited options of where else to go. Where that number, if we need 22 million bushels to meet the USDA's projection, if this number turns around on a weekly basis, we start getting 25, 30, 35 million bushels, then to borrow from the Wild West shows, Katie bar the door, literally in terms of where those markets they'd have ongoing strength. That's for sure. And that's for all U.S. wheat exports. For hard red, again, strong week last week, a little bit lower this week. Again, prices jumping up. You'd wonder, with such high prices, when would that demand actually come? It would come, I think, after our harvest, as we get closer to or have our harvest in. The world looks around and is short on supplies for wheat, and then they come looking to whatever's left, and that'd be the U.S. Even with our high transportation costs where we're located to all these other markets. And so I'm not trying to scare people in terms of what could happen, but I think this is what occurs when you look at the Black Sea region, either because Ukraine with its damage doesn't get its crop, or Russia with its sanctions doesn't get its crop available. Then you have to wonder about those fringe tail scenarios that are more a higher possibility now than they were not that long ago. The USDA came out on Thursday, Friday of last week, and in fairness to them, we were just starting to see all of this happening in the wheat market. They came out and projected for this current marketing year $7.30 as an average. I have a mechanism. There's a mechanism available to look at futures prices for this marketing year and the next, and assume basically I assume current basis levels spread out on into the future. Where we're at now is best predictor of where we might be later on, and projecting the season average price for that current next marketing year. So the USDA projected for this marketing year that'll end on the 31st of May, 730. It looks like the futures are saying more like 8. But the real issue is, and either you'll agree with this or just look at me like I'm losing my reasoning faculties. The USDA projected $6.80 for the next marketing year. So they're assuming normality, that markets aren't in an uproar. Ukraine comes back and there's not any big issue. They projected 680. The futures right now, using what we just talked about, Mark, I'm almost afraid to say that number. It's over $10. So that's the fearful scenario that's out there, and that's what the futures are pricing right now, in the run up they just had. Any thoughts, Mark? Comments on that?
Well, Dan, I tell you, I'd ask. Let me run a quick update here. We've got the Chicago wheat, so the soft red is locked limit up at 75. Hard red, I'm talking to May contract in both. It got up as high as 75. It hit the limit, but now it's only up 21. Actually, now only 16. Any thoughts on why hard red is not chasing the soft?
I only saw one or two comments on that that given the limits affecting hard red trade, that there was kind of the idea that most of the volatility is probably going to be reflected in the Chicago contract, soft red. It might just be for volume sake, liquidity that people are going there. But what I wonder on, Mark, is whether non-ag money sees what's happening in the wheat market, is starting to enter in and in a very speculative manner to drive this thing up. That's not unknown to happen. There was a time, but about 4 or 5 months ago, where I was involved in a discussion. Guy Allen, our colleague at IGP, was in a discussion with some regular commodity traders, and there was this discussion of, well, where do traders go to reflect inflation in the general economy? Is it oil, wherever? Well, the comment that came back to him was, well, in circumstances like we're in right now, it's in the grains. I wonder about the investment of outside money coming in and affecting the wheat futures complex and giving us outcomes like this, where, gosh, if those prices are really the way things work out, then we're over $10 for the price of wheat. So let's go on. I've got some supply demand numbers there. I try to look at the world minus China. Interesting headline last night that China, even with their, when you look at the difference between the world aggregate supply demand, 35% stocks to use in that bottom line in this current marketing year versus world minus China 21, that China now is active in a number of markets trying to buy wheat. Well, that 14% difference is to represent China's stocks. But if they're out chasing, and that's meant to keep them from insulated from their population having food inflation. Well, if they're out chasing wheat also, then you wonder about whether they really have those stocks. So anyway, but that 21%, and that's not even really representing that's consistent with where we were before Russia, Ukraine, that's showing the tightest stocks to use in the world minus China perspective, that since 2013-14 at least. So driving factors, the wheat market's tightening wheat stocks to use, wheat for current crop, current new crop, 21-22, tightest ending stocks since 2013-14 at 33%, highest price 730. The world wheat market from a world minus China perspective, tightest ending stocks since 2007-8 at 21.2, and the record high dollar adjusted price at 831. So it is as it is. Take a look at corn. I'll try to move quicker through these others. For corn, pretty similar. Again, almost the same, really the same, the same shape of a chart, except you don't see the extreme high moves that on this that you see on wheat. Trading now, had been trading kind of loath to go over 650. Well, now we're $1 higher than we were, and spending time there. And weekly prices, again, you can see a strong uptrend. Are at a higher than we were back in the summer of 2000, the spring, early summer 2021. 76% are at 76 RSI, 27% rate of change on a weekly basis. Daily, strong uptrend still continuing. So we spent most of our times in these workshops, Mark, talking about corn, and we were looking at new crop Dees corn. And new crop Dees is probably behaving a little less volatilely than this. This is the continuous daily chart. But in a market like this, I think which we kind of developed towards the end of these workshops, which comes into play to where you would probably wait for the market to come down and break through, say, the 9 or the 15 day moving average before you'd price it. In an uptrend like that, you'd probably tend to let it run, especially with the RSI at 74, 75 and the 14% rate of change in the market. What are your thoughts, Mark?
Well, I was just looking at that. I got the luxury here on the side here, looking at the December chart.
Right.
And it's a question I'd ask is, today we ran that thing up well over. I mean, like our high today got up to 647. So it's a Friday, and then the last Friday, a week ago, then 5/20 or February 24th, we got up to 646. Both times have not been able to hold that. I guess bottom line, I'd say it's all way too early, and I would agree 100%.
Right.
That could be topping out a little bit here, but I think with being March, I just don't want to get too far ahead. Right.
And who wants to be in?
I don't want to do anymore.
And who wants to be in an open position over the weekend anymore with all that could happen here? That could be in play too. It's a Friday.
Yeah, and as of right now, according to our quote plan, we'd be waiting for a close above 630. We're not doing it right now.
Right, for Dees corn.
Yeah.
Okay. Again, you can see the tightening up of the world minus China corn here at 10.2%. That third column in on the lower part. Interesting. Whereas we're waiting for wheat stocks to start to come in, for corn, it's already happening. We're pulling in. We have actual exports above the pace that's needed to meet the USDA projections. So that means that the USDA is very more likely than not to up their export projection, lower their projection of ending stocks for this year, and just add that much more support to stronger prices. You can see they came out projected for this current marketing year at 545 for a price by looking at futures, probably supporting on yesterday's closes, more like 582. They projected $5. And I really looked at that one sideways, wondering if that was right or not, what the reasoning was. There's some support for that. They're projected $5. The futures right now seem to be looking at more like 550, at least by the way I calculated it. So, 30 to 50 cents low, probably, in terms of the way the USDA is looking at things. But again, we've got several days of strong markets that we can rely on that they didn't have when they made those projections. Markets, third tightest ending stocks to use since drought year of 2012-13, with down 7.4%. We're at about 10.3 now, but we have the highest cash price since that time, 545. World market, tightest ending stocks to use since 12-13, 10.2, and trade weighted dollar, highest since those drought years at 612. So strong markets again. Quick look at sorghum, and sorghum exports are choppy, up and down. This week they were down to 5.4. Last week they were up to 10. But that's sort of the mode. You know, it's a less liquid market, less consistent. Generally, well, you look at that top box, total sales through February the 24th, and for 84% of the way to the USDA's projection, and only 48% of the way through the year. So pretty strong, bullish. And for sorghum, USDA projected also 545, looks more like 621, given current basis bids would be where what the futures are kind of indicating. They projected a lot more conservative on the on next year. They projected 490, and the futures are saying more like 6. So interesting. For soybeans, again, you coming back in and looking at this chart, pretty similar to where we were on some of the others. Again, we had strong run up. We got up to over $17 on the May contract on about a week ago. Have come back down now about 1667 3/4. Got a market that's still pretty strong. Again, still uptrending all the way through. We had I think was it the meeting in Solomon where we focused on soybeans. Again, RSI 76%, so strong market. 32% rate of change, also strong. That was on the weekly side. On the daily side, if anything, it looks like the daily side that soybeans are a little less prone to run up than they're a little less strong. They're still strong, but not as much as for corn or for wheat. And that could be that what harvest is coming in South America is starting to come out of the fields now, and likely to be a little bit of a buffer on U.S. prices. So I think it's probably a South American harvest issue. And still have export shipments, 27 million bushels. I need 20 to meet the USDA's projections. About 3 or 4 weeks ago, that was at 60, 70, 80 million bushels. So that harvest South America is coming in. And some pretty strong oil market. I understand that the palm oil industry is suffering over in Thailand. So we kind of spent time talking about these other markets, how it seems that they're pretty low relative to that the USDA's projections are low relative to the futures. Actually, for soybeans, they're about right on. USDA projected this current marketing year we're in through August 31st, about 13. The futures are saying about 13, 14 for the next one. They're the USDA projected 1275, about the same as this marketing year, about 13 for the futures as their projection. So interesting. And for soybeans, we're okay in terms of ending stocks. 6 tightest stocks to use since 12/13, so about middle of the road, about 7%. Second high soybean price at 13. In terms of a world less China perspective, tightest ending stocks to use since 15/16 at 23%, and record high prices 14.79. Mark, I wanted to show you a couple more things here and show everybody something that we've been talking about, particularly for corn. How do you view what's likely to happen in the futures markets from now forward to harvest? And we've talked a lot about seasonality, and how we designed these marketing plans these pre-harvest marketing plans to allow us to take advantage of what was available in the markets, what tended to be higher in most years, higher prices during particularly April, May, June, July, than we were going to end up with in fall. So kind of have looked at this and turned all these futures into percentage changes instead of prices, so you can put them on equal footing for comparison. And when you throw all the years together, you've got kind of a situation where And given that we're at about day 179 from 178 from expiration on the DEES contracts, went back to 2000 to year 2000 for that DEES 2000 futures contract. And you've got, when you throw everything together, you do show a little bit of a through day about 139, 132. So basically another 40, 50 market days. You have a little bit of strength, and then you start to go down lower generally for DEES corn. But there's difference in marketing years. So I decided I'd separate out the years where there was no spring rally, like we're just seeing now, and again during January, February, and heading into March, to separate those years, kind of quote more normal years without any crop worries versus years when we do start to see rallies, and because something's happening in the market. So first years without spring rallies, that median line is kind of the average percent you're looking at on day about 179. You're about 110% of this of the price where you're going to end up when you get into the delivery period, the first 10 days of December. So you tend to see about a 10% drop in those years from, on average, the median, middle of the 50% higher, 50% lower than that. And you have the 75th and 25th percentile. That's basically you're catching between those two yellow lines 50% of what's going to happen. And then there's the minimum, maximum, and the out on the edges to catch if there's any extreme years. But generally you move down about 10%. But you tend to hold up decently for a little while, for about another from day 179 till about day 155, but then things start to recede a little bit from these highs. But that's not the interesting one. This to me is the interesting one, because this is a year kind of like this one, and there's about 6 or 7 years like this, to where prices when we do have spring rallies in corn, where we sit on day 179. There are times, and particularly one or two few years on the top side, get to day 137 before expiration of that contract, where you're holding it pretty strong. In fact, you can argue you hold up strength pretty decently, pretty decently through about day 189 with some ups and downs, and then but so there's two things out of this. In years where we start to see problems early, it looks like we're holding up decently for prices, and I'll do some more analysis of this. But the run up, we got as much in terms of the median, just everything all added together, about 20% higher than where we finally ended up at. But then even with that, almost all these situations, you ended up that the price strength that we've seen in the summer ended up and went away. Only in a few of them on the bottom side below that line. Once we got to about day 113 or so, we gained a little bit, but most of the movement's happening on the top side, where we're losing that worry in the market and moving to the lower side. Mark, I probably haven't done a very good job explaining this. How do you respond to that chart?
I'm still studying it. We're comparing that thing always to what the harvest price was, and that's probably why it always goes down back to 100%.
Yeah,
right?
That's right. That's right.
Up there. Could you go back to the average
of everything all together?
Well, okay. On this one here, I guess the question I've got then. So basically, we're saying in that period of 137 to 131 days away from harvest or going off the board.
May, June.
That's when it's the highest, correct? 120?
Yeah.
And I guess I'm going to guess that's corresponding to that June, July.
Yeah.
August
you're right in
period.
those areas. Yep.
Yeah. So, I mean, basically this is another, I don't want to say another way, but a way of also just, these are the same kind of things you'd see with the seasonal index. Prices. But the nice thing is here, you pulled out and said, hey, when we don't have a spring rally versus when we do have a spring rally, points it out. And so basically this would suggest that the odds that we're going to jump this thing up possibly another 20%, right?
Well, or
Pretty good.
well, at least at their strength, to see through spring from here. If we have problems now, we're not going to get that uncertainty resolved until we get the crop in the ground and we start to be not worried that we're going to lose the crop on top of the problems we had in the spring. So I did this also for wheat. Now for wheat, you throw everything together, man, it's a sideways world. You know, we're in about day 95 from expiration of the July contracts. I was looking at, and we talked about how now they've gone to September, but July contracts, and interesting, and when in years when there aren't rallies during January, February, March, April, pretty much a sideways deal with a little bit of movement. But you know, when things start to happen in the spring, we get out to about 48, 50 days before that contract goes off, which where would that be market wise? If there's about 22 market days in a year, most of these months. So about 2 months out. So instead of July, you're in May. Out in May, there's some volatility. So big difference in the year. And here, so we're in a year where most of the time these are production issues. We're in a year now where it's geopolitical issues and production issues. And to me, this would, I think, lends credence to the idea that the volatility and uncertainty we have now is going to stick around at least for a while, and until we catch some rain and are more sure that the market that we'll actually have a crop here in the U.S. and around the world. So kind of evidence for the endurance of the current price situation. To take a look at soybeans. Again, soybeans, a sideways world in most of these years. You throw everything all together, and again, a lot of that's because South America is coming in so strong, and they kind of mitigate our own issues. They kind of take over leadership. In years without spring rallies, still a sideways deal. In years where we do have spring rallies earlier on, and some of that could be due to South America, you know, we tend to, you know, there's a difference between this relatively flat view of the future and this one where you're tending to move higher again. So this the evidence from up front where we had problems, we tend to find support for these markets from where we're at now, day 179 or 178 on for another 70 years or so days, which is about 3 months. So we're here March, April, May, June. Again, more support for the seasonality of strength of seasonality going forward. Well, that's what I have. I haven't been watching any questions. Are there any questions that have come in?
I don't have any on here, Dan. Folks, go
Okay.
ahead. If you do have something, you can put it in the chat. That's down in the middle of the Zoom at the bottom there, middle of the Zoom window.
Well, I have to admit, there's so much going on in these markets that it's hard not to. I don't know that you say you get excited about them, but to try to understand them is really quite the situation, and then to try to figure out where to go and how to manage this volatility, quite the situation. So, Mark, we wondered about rolling issues forward, either as you had talked about it, rolling price goes forward or not, and boy, I don't see where the resolution to this uncertainty, the wheat market or the corn market, or even really for soybeans, is gonna come quickly. Jay, do you have a question? Might have to unmute you.
And Rachel had one. The local elevator currently isn't taking any forward contracts for wheat. Can you provide an insight as to why? It's in the chat.
Yeah. Okay. Let me get back up to this. Okay. Can you see that now on there? Rachel, I think that's an issue that has just happened in the last 2 or 3 days, really been having been discussed in the in the wheat market. And in trying to understand it, they're concerned about tying in, where's their typical practice, if I understand it right, was to look at, say, a July contract at 1133 with all this volatility and uncertainty that's out there. And with what we just talked about, hey, who can deny that we could add $2 or $3 on top of this? They just don't know. So their first move in a lot of cases was to go out to the next contract, 1070 for the September contract, which that to drop the price offered by that differential, which is, and yesterday was 60 cents, and I assume something similar to that. Their first move was to drop that in terms of protection, and then and then beyond that, I don't have as good an answer as I should, but I think they're just stepping back from making any commitments in such a volatile environment that they feel they may have trouble fulfilling. So that's my understanding. Mark, what are your thoughts?
I tell you, I'd say ditto on that. I think, back, I want to say in that 2008, 2010, but definitely 2008, 9, we had some periods where there was just incredible volatility. And we saw a lot of elevators just say, hey, we're backing away from this crazy thing. And I think Dan alluded to it earlier, and I was checking multiple elevators just trying to take a look at that. A lot of them are still using the current months, but as to his point, yeah, we're already seeing some going back to way deferred. There was one elevator here in Kansas that's pricing new crop, old crop off of September corn, and September wheat. So they're going way back. And it's just like they're all trying to get to a place of less volatility. And basically just exactly what Dan said. We're just taking a step back from this market because if they forward contract, they're going to take a position in the futures market and they're getting whipsawed. And they don't want to do it either. Now, I think there's another question here in regards to, are there resistance levels that we could use to determine pricing opportunities, or are we in uncharted territory? Again, I would also ditto that thing. We talked earlier, a lot of times when you see such incredible volatility, technical tools are much less reliable. You can blow through a line of resistance. But Dan, do you have any thoughts on where a person would want to draw some lines?
I'd never heard of this before, Mark, but I heard someone talk about, first of all, can you see DTN up in front of your screen? Are you seeing that? I'm trying to share that. Did that come up?
Yes.
Okay, good.
It's real small.
Okay, let me pull that up. Let me get to where I'm trying to get to, then I'll show you what I'm up to. Are there any levels of resistance? Today I heard something I never heard of. Came out of a DTN commentary. They were looking at wheat, May wheat, and let me pull this up. And they were using something. They were using Bollinger Bands. They said that the Bollinger Band was the only level of resistance on the downside. What? I never heard of a Bollinger Band being a technical tool, but it was something that as I understand, it's a one standard deviation move from an average over time. So they were looking at this out here. If you can see what I'm showing, it's 1134. That was yesterday's market, and saying the only downward resistance was this quote Bollinger Band as it was moving up. So are there any levels of resistance? Mark had brought this out quite a bit in our discussions that when things are moving up like that, really the main thing you've got is probably a short-term moving average. See a three-day average moving through time, or we were using a 7-day average. Pardon me, in those workshops. But so in terms of on the top side, you look at historic highs. And I think, although I don't have it up here right now, I think for wheat, we may have, we've certainly been higher than this. I'd have to go back and, okay, just a minute. I'm not sure if, are you keeping up with me? Is the
Yes, Dan.
monitor?
Yep.
Okay, good. Okay, so hang with me here. Okay, for Kansas wheat, I'm going to look at monthly wheat. It wants me to buy things. Okay, there we go. Monthly. Okay, monthly. Okay, no indicators. Okay, so you look at monthly wheat futures. See, so we're up here today at 1205. We, we did get back in 2007 when the wheat market really jumped. We got as high as 1395 on the high side. Yeah, 1395, 1357 for a couple months. So that's the very historic high in wheat. So someone could use that, but still that's another, that's another dollar or so away. But that happens that was such an infrequent occurrence. I just think it's like a, I'm not sure you asked that question, but if you're a horse person, it's like a horse that got its nose in the wind and just decides to run. It's just running. And and you throw in rumors about again nuclear plants and whatever else, and it's just running. So a lot of really exhibiting a lot of fear right now on the buyer side in terms of where things could go. So that's not much of an answer. So we're looking for way historic highs on the one hand, and wondering what new technical tools might give us for something to gauge against. But it's just so much fear and emotion in this that we're just running with our nose in the wind.
Dan, you've got another one. It's in the chat if you want to open that yourself, or I can read it to you.
Go ahead.
And folks, it's possible now to unmute if you want to just talk. The question, what if we've priced our wheat on the July board? How do we manage our cash pricing if the elevators have rolled to the September contract? If I roll into September, I will lose over $1.
Right. When you say you've priced it, have you taken are you talking about someone that would take a hedge position? Is that what we're referring to? They have a hedge in the futures and they're going to carry that hedge to its fruition once they harvest their crop?
Yeah, Dan, I interpret it as we've sold July futures.
Yeah.
My elevator is running, off of the September contract. And what if I want a forecast contract? Because now I'm $1 down with the spreads, right?
Yeah.
Kind of where we're looking at here. And also basis is just awful, right?
Yeah, that's we haven't talked a lot about that, but that basis says in a lot of local places is widened out purposefully in protection for these same reasons we've been talking about. It makes a big difference if it's a theoretical question or if it's really is this a hypothetical, or is this in reality what's happened?
The way I read it, Dan, it's actually happened.
Okay.
I think like Mark said, they sold the July.
Well, one way to look at it could be that, and so they want to get out of it, so they're in a futures contract, and they have had. Yeah, go ahead, Gail.
Yeah, actually, it's Russ, but that's my wife's name. I don't know why he got on there. Yes, no, we sold a board here. Well, this would have been last fall for $7.55. Well, okay, we were going to just carry it through as a hedge and then lifted it when we got the grain and sold the grain cash. But now with the basis and with cash being priced even lower off the September board, we're going to take a pretty big hit. Not to mention anything else.
So so you're hedged right now and from 750 to, and that was to July. Is that right?
Yes.
Okay, let's just check something. Okay, we get to the quotes. Okay, so July is now is 11. So yeah, so that's about a $4. So that's a $4 hit off of that. So I hope this is a reasonable way to look at it. So the hedge, so you've lost about $4 on the hedge. You haven't, and hopefully in most cases we're hoping that the basis will at least stay level. Well, here the basis is weakened by, so you've lost $4 on the hedge. Hopefully you still you gain 2.5 on the cash, you know, in the cash market as a run up. So your net, as the basis is weakened, it's taken, and now it's a lack of availability too, isn't it? So you're stuck in a conundrum. Am I thinking about, am I circling the wagon to get at the description of this? So loss of $4 on the future side, but the thing that's but you could go ahead. So if you do forward contract out there to September, what's that forward contract price now?
I do not know.
What's your now on this? If this thing is still following us, I hope it is. Give me your zip code. I can
67154. I'd probably be pricing it out at Bartlett and Wichita.
Okay. Rich, can you help me out? What's a good zip code for Wichita? Hutchinson won't be far off from that. I know Hutchinson is 67401. Oh, okay, 67501. Okay. Okay, so let's see. So and that's for soybeans. That's for wheat. Okay. So for hard red winter wheat, your forward contract price, let's see here. Okay. The best price, if you would be out there in, well, let's say Mid-Kansas Co-op, 1126 or Farmers Co-op, let's say 1126 as a forward contract. Okay, so, Mark, I know you said you'd looked at those bids, but I think DTN is assuming these bids are all off of July, and I'm not sure they still are. So anyway, if they're off of September, well, you've asked me a straight question. I'm hemming and hawing around because I don't have a good answer. In the worst case scenario, I think a person probably gets out of that. Well, you would hope that this market just quits running up and would stop. But if you stop the bleeding on the hedge count, you're going to lose $4 basically. You know, you're going to lose $4, and so then you're done with that, and then you turn around and then you're protected at least from losing any more on the futures run up. But the market could keep running up, and as you know, the trends are upwards. So you could be helped out a lot by continued uptrends in the market, and then you'd end up in forward contract out there off the September contract, and maybe it's let's say it's 1070 or something, 1050. Right now, if we run, we could still run up $1 or more on top of that, given this market. And it could be that from that the 1070s still probably well above your cost of production, I'm thinking, and you could mitigate the losses from the hedge account as you roll on into the future. In that, you're kind of violating the rules of a hedge count, you know, where we say, gosh, you hedge, you can't take it all the way to the back end and you're done. But what the rules have been violated is that the elevators aren't playing as a fair partner. They're refusing to come through and give a forward contract in the time frame that you were planning for. Does that help at all, Russ?
Probably not.
Yeah, I don't think it would help me either, but
for a bad scenario here, unless the war gets over quickly.
Well, perhaps you get out of the. Perhaps I would wonder about getting out of. Stop the bleeding. You take your losses up front. Stop the bleeding on the hedge account, because it's surely going that way, and then we're not assured that this is over by any stretch. The thing to remember on wheat prices is that over 25, it's 28% of the world's wheat comes out of Russia and Ukraine. And it's very, very questionable whether we'll get anything out of Ukraine at all this year. It's a question, and Russia has such sanctions. Are we even going to be able to trade with them? So that $4, you in what could happen, you may make up a good part of that $4 by inflation that could still happen in that price.
Okay, well,
that's my thought anyway. That's
Okay.
trying to make the best out of a bad situation. That's for sure.
I might throw in a couple cents here, and I tell you, Russ, I'd be more than happy to visit with you and Dan offline at some point. But I wonder, would this be a place where a person would look at buying a call option in order to cover that futures position to again kind of stop the bleeding and allow that thing to run up at some point? Then you may get out of that thing if it just whatever, but you stay in that futures position, but you buy a call option to kind of cover yourself there. And on the cash side, you're not looking at trying to lock in cash at this point, are you?
No, I'm just worried about the convergence of cash to the board come by.
Yeah, and on that point, this is going to be the first real test of the variable rate storage, I think. If we see, and it's designed to work that way, that we should see the July contract come back to convergence when it goes off the board, regardless. Well, I mean, I guess it's working right. If they're quoting their futures or their, if they're quoting their new crop already off of September for delivery in July, we'll have to see. But, hopefully maybe we might see that space between those two narrow up a little bit, not hurt you as bad. But I'd wait out the cash side a little bit. But I don't know. This might be a place to kind of consider looking at buying that call option. Ben, what do you think of that?
I was just looking at it's no cheap thing, and at the money call.
I wouldn't buy it.
$1.50 if that's shown on the
screen. I'd be buying it out of the money, because they're all a little bit if prices rip up, right?
Yeah.
But I'd be more than happy to take this offline and maybe visit more about this if you'd like.
Yeah. I'm sorry, Russ. I'm not giving you a good answer to your question.
Well, no, that's good. I thought maybe the fact that you don't come up with a good answer makes me feel a little bit better, because I haven't been able to come up with a good answer.
other than perhaps to stop the bleeding of what was at that time was a very good position. The 750. How can you argue with 750? But this other international stuff's really come into play.
Yeah.
Well, we've got about 4 minutes. Jay, did you have a question?
Yeah, I was the one that asked about the resistance earlier, and I'm looking at different things and thinking along this corn line. Is there a price where people have to start looking towards alternatives for feed, ethanol use? I mean, with $100 barrel oil, it changes the whole dynamic there. There's just so much at play here between inflation and outside money. And I mean, I'm almost longing for the days when high fertilizer prices were our issues. It's not an issue anymore.
I think your my initial thought is I'd watch what the corn bids are on the ethanol plants. What they're bidding is, as they try to make profits. those prices daily are going up and down. A lot of times the ethanol bids at the plants are they can be sharply higher than at local grain elevator markets. So, or local grain elevator bids. So so it's not a perfect limit, but like where you're at, you have some ethanol plants, and Lyons isn't far away, and you've got down by Pratt. I guess I would watch the move of those prices as at least a barometer of what the ethanol industry is saying anyway, for what their break even is. But so I don't know that I'm getting at your issue of what's so they're operating on the margin. I do calculate break evens on ethanol plants, and the last time I looked was about a week ago, and they had been making in November, December 65, 40 cents, etc. Came in here, the latest numbers, about 2/3 of the way through February, they were losing 25 cents, but still had pretty strong cash grain bids. So I have read here just this morning that with the run up in RBOB gasoline versus the relatively docile ethanol prices, that probably going to be in that it's very likely if gasoline prices stay higher, it'll help to mitigate the blow of high corn prices for ethanol plants.